Investors are navigating a very different landscape than the one that defined the past decade, marked by shifting growth patterns, stubborn inflation, and higher for longer interest rates. In this environment, old assumptions are being tested, and portfolio decisions that once felt straightforward now require a more deliberate approach. To help make sense of the opportunities and risks, I'm joined by Tony Ciero, President and CIO of Caldwell Asset Management, a division of Caldwell Securities Limited. Tony, thank you so much for the time.
Hi, Teresa. Thank you.
Now, where are we in the economic cycle, and which asset classes have historically performed best at this stage?
Well, I believe we're it's still in the expansion phase of the economy, more so in the U.S. than in Canada. But we're just growing slower than we had seen in the past, especially over the last 3 years. Inflation has cooled from its peak, and I don't think recession is imminent anytime soon. And generally speaking, in this kind of environment, yes, stocks continue to do better versus cash or bonds over time. But underlying is having the some kind of balance between stocks, bonds, cash, and private investments that fits your overall risk profile. The takeaway, I guess, is that it's not an all-in or an all-out environment. It's owning the right mix of growth and stability in your portfolio going forward.
And how persistent are inflation and interest rates? And what does that mean for the balance between equities, fixed income, and real assets?
Yeah, good question. Inflation is definitely lower than it was a couple of years ago. Coming out of COVID, there was a pent-up demand to go spend, take trips because flights had been canceled, going to restaurants, and that drove price pressure going upwards. So inflation is definitely lower than coming out of COVID, but it's still here. It's not disappearing anytime soon. And interest rates are coming down, but they're still higher than they were pre-COVID. So, that means over the last 5 years or so, portfolios should be changed how they were built. If we were looking more specifically at stock growth, well, maybe now we should consider some bonds because they still remain attractive because of the higher level of interest rates. And you still need some stocks for growth. And of course, real assets. I mentioned private equity, for example, to help protecting purchasing power over time. The key is balance and not necessarily betting everything on one stock or one holding.
And why is it important to understand whether your current asset mix is aligned with today's opportunity set or still positioned for a market environment that no longer exists?
Yeah, a great example of this is technology and artificial technology stocks or artificial intelligence, sorry. The last 3 years that have been driving the returns for the S&P 500 US stock markets. So they call them the Magnificent Seven. And I see a lot of clients' portfolios that are still holding quite a bit of weight in, any one of those seven stocks. Maybe it's time to consider a different approach. And I think going forward, it's not necessarily, latching on to the wave that worked in the past. It's more being more thoughtful of where your money should be allocated. Reviewing and adjusting the asset mix ensures the portfolio would fit today's reality and not just yesterday's performers.
And why is diversification of a portfolio's return drivers more important for an investor rather than just the sheer number of holdings?
Yeah, that's a common misconception because people think they have diversified the risk if they hold 20 to 30 stocks, for example. Well, that might be the case. You are diversifying away from what's known as unsystematic risk, the company specific risk. So if you hold one company that goes to zero out of a total of 30 companies, you still have a lot of protection. But it doesn't get rid of what's known as systematic risk when the whole stock market declines. It doesn't matter how many stocks you have, you're going to be participating in that. So diversification in terms of the portfolio's return drivers means just not depending on stock performance to be the driver of return. Also look at bonds because bonds can help protect during a decline. And I mentioned private equity before. Private equity don't necessarily come with the same risks as investing in stocks. Their risks are more associated with time, because it may take a long period of time for a private company to cash out, let's say. but those risks are definitely different than the stocks, and bond risks are different than stocks. So diversification means introducing these different return drivers to your portfolio and not necessarily just being, having your whole portfolio contingent on one return driver and just being stocks.
And in a world of more modest and uneven returns, how much value will come from getting asset allocation right versus trying to time markets or pick winners?
I'm gonna parlay this to yesterday's Super Bowl. Trying to time markets or predict stock winners, it's a lot like predicting the Super Bowl outcome. And you might have a general idea that Seattle may win or New England may win based on who you're rooting for, but you can analyze all the stats and listen to all the experts and still get the wrong outcome. The importance is you don't need to predict every play or the outcome. You just need a strong team that gets you through the hard times, like when you're losing momentum in a Super Bowl game. If your team is strong, you'll see that through. And I parlay that to, again, the asset allocation. If you have a strong portfolio built based on your overall risk profile, you can see the ups and downs when the markets are there, and you help reduce those wide swings of your portfolio to a zone that you're more comfortable over a long period of time. So having the right asset allocation mix for your portfolio that matches your risk profile will help reduce volatility, minimize the drawdowns, and help achieve your overall rate of return that you're looking for over a longer period of time.
And what advice would you give to young people who are looking to get into stocks or build portfolios? What would you say right now with just how uncertain the markets are?
Yeah, don't go with what's the flow out there because you're going to get hurt. If you went, for example, Bitcoin at the end of last year, we saw a height of 125,000, and there was a sheer buying of that. And you see that just several months after that, be eroded by half. And that does happen. And we see that in the price of silver and gold having these big declines of 10 to 20% within a day. So careful just going with the hot item, the hot stock, the hot thing, and do a little bit of homework and try to understand what is your overall risk profile. Because once you understand what matters to you, if you're starting with an investment portfolio of $1,000 or $100,000 or $1 million, how much loss can you stomach on that portfolio? That will help you understand what your overall risk profile is, and then seek some guidance from an expert if you find it online, or speak to somebody, a professional in the industry that can match a portfolio based on your overall risk comfort zone.